Welcome to the launch of The Future of Finance, a series of reports exploring the key trends in global finance over the next 2 years, produced by DIFC in partnership with Asia House. I'm Michael Lawrence, and I'm delighted to be moderating today's event to launch the series. Thanks to the scores of you who have joined us from across the globe today. I'm sure you will find it a stimulating discussion. Today, we will be examining the evolution of financial services as the industry adapts to multiple changes and challenges, from the emergence of new trade corridors to shifting capital flows to technology and its impact on the sector. Today marks the release of the first report in the series. It's titled The Global Finance and Investment Outlook, Charting Technological Shifts and New Global Flows. It's available now, and we're sending you a link to it in the chat box on Zoom. So please, when you have a moment, do take a look. Our research includes the insights from a roundtable of 24 industry leaders who joined us for a wide-ranging discussion at DIFC in Dubai. It includes interviews with experts and extensive desk-based research. We looked at the macroeconomic outlook, emerging trends in the industry, and new opportunities that those trends present. We also examined the risks, including growing protectionism, persistent inflation, geopolitics, and regulatory fragmentation, and how the industry might navigate those risks. In a few moments, we will discuss the outlook with leading figures in the financial services industry. But first, Freddie Neve, Lead Middle East Associate at Asia House, will present the key findings of the report. Freddie.
Thanks, Michael. Let's start with the macroeconomic outlook. Our outlook for the year is positive. The global economy is ultimately resilient and set for moderate growth. The US will be a major investment destination in the year ahead, and China is on a pathway to moderate growth despite dampened forecasts. We identify three main headwinds that may complicate the outlook: inflation, protectionism, and US-China relations. However, we believe these risks are navigable and remain optimistic about the future of finance in 2025. So, how will global finance change over the coming years? We forecast realignments in three key areas: geographical, capital, and technology. Starting with geography. The economic center of gravity is shifting eastwards. Emerging market economies such as ASEAN, India, and Africa are all forecast to outpace the rest of the world. Expanding populations, middle-class growth, and digital adoption give all these markets strong and long-term growth prospects. The Gulf, too, is also primed for growth, with economic diversification and reform leading to new growth opportunities in new sectors. But crucially, we find that as these emerging economies grow, so too will they become more interconnected. And this is going to create new economic corridors that will become the new reference points within the global economy for investors, with, importantly, the Middle East at their center. In particular, we highlight growth along the Gulf-Asia corridor as a key bright spot within the global economy. And, crucially, for financial services firms, this eastward shift means that those who understand these corridors and base themselves in them will stand to benefit. We're also seeing structural shifts in the nature of capital. Private wealth is growing in importance as a driver of global investment. As the graph shows, the number of millionaires and billionaires is increasing, but crucially, they're also becoming more mobile, flowing to geographies that best cater to service their wealth and unique requirements. One major opportunity in particular that we identify is that this wealth is soon going to pass down to the next generation. And this transfer is going to shift preferences regarding where and how capital is deployed, with, for example, a greater emphasis on technology, sustainability, and social impact. Wealth managers who can capture these evolving preferences will benefit. Finally, in technology, AI will not only bring radical innovation to the financial services sector, but is also going to be a major investment theme in its own right. AI is going to be crucial to financial services innovation, automating routine tasks, enhancing risk and portfolio management, and improving customer experience. But so too will finance also be crucial to the development of AI. We expect significant capital, for example, to flow into the companies and startups at the forefront of developing the technology, but also into the infrastructure that underpins AI. As the graph shows, data centers received a record amount of private investment last year. Our report also finds that regulatory fragmentation continues to challenge the global adoption of AI. And ultimately, to realize the promise of AI, we're going to need good regulation. So, amid all this change, the opportunities for financial services firms are significant. We explore these at length in our report, so please do download the report. Back to you, Michael.
Thanks, Freddie. It's now my great pleasure to welcome to the discussion Simon Ahmed, Global Head of Macro and Strategic Asset Allocation, Fidelity International, who's joining us today from London. Tomil Bag, Chief Economist and Managing Director of Group Research, DBS Bank, who's based in Singapore but is joining us from Dubai today. And also from Dubai, Reese Merrick, Managing Director, Middle East and Africa at Ripple, and Salman Jaffrey, Chief Business Development Officer at DIFC. Thank you all very much for being with us. It's important, I guess, to start with the macroeconomic context. And Tomil, to you first, trade wars, inflation risks. It's an uncertain outlook. What are you seeing for the next 12 months?
Michael, great to be with Asia House. I think Freddie did a great job of teeing us off. I think the noise around the near term is substantial, inevitable, and almost unforecastable. So let's not try to get inside Donald Trump's mind and his reaction function with respect to reciprocal tariffs and countervailing measures. I think we should start with the premise that the global economy is not particularly fragile. So the absorption capacity of shocks or the ability to deal with a lot of noise, I think is decent. We had a great year in 2024 with respect to trade. We had a pretty decent year in 2024 outside of the US, which of course has been delivering exceptional growth rate. But even if you take the US out, it's been a good solid year. The fact that we have had fairly high interest rates in most countries in the world, both in EM and DM, for a couple of years now, and not seen any wholesale currency crisis, debt-related fragility, and spillover risks, I think is a reflection of the underlying strength of the global financial system. The fact that the quantitative tightening has not led to any dislocation in the funding market, I think is a good one. It also says volumes about how well central banks have done in terms of fighting inflation, with mixed track record nonetheless, but they have fought it. And at the same time, they have not created tight financial conditions that would take the rug out of the global economy. That's the good news. The challenging part is, of course, the noise coming out of the US. But again, in times of challenge lies opportunities for realignment. I think Freddie sort of foreshadows that in his piece as well. Whether it is geographic realignment or some degree of pragmatism over idealism, I think that's a good thing. A classic case in point is India-China relationship, which has been rather contentious in recent years. But if you look at the news flow out of India-China over the last 6 to 9 months, there is a discernible thaw in that relationship. And I think it's a powerful driver of positivity in the region. Chinese engineers who could not get visa to India are getting visas. Indian companies are doing 50-50 joint venture with China. You drive around India in MG cars, which I think most Indians think are British cars, but they're actually Chinese cars, but with a 50% joint venture with an Indian manufacturer. So I think the fact that a key area of friction is now paving the way for a greater degree of pragmatism is a useful antidote to the noise that seems to be inevitable and everlasting from the US. We should also focus on the secular trends. Because we can't forecast the noise, we need to sort of take solace in the fact that around technology, around climate transition, it doesn't really matter what the US does in the coming years. it would be trends that would persist. The fact that in 23 and 24, China's additional wind and solar energy capacity was more than the entire stock of the US renewable energy capacity, tells you that the green transition related technology capital formation has shifted from the West to the East. The US getting out of climate treaties or being tough on wind energy generation is a US issue. That is not a regional issue. Similarly, in terms of tech adaptation, we can have all sorts of noise around AI and controversies, but the fact of the matter is that is a subset of the entire area. It's not just about data centers and AI model inferences. On the chip manufacturing side, on Internet of Things side, we're seeing substantial flow of capital in the region. Just between Singapore and Malaysia, my epicenter, $45 billion worth of FDI came in 2024. These are seismic numbers. This is a purple patch with respect to investment not seen in recent memory. We will worry about the noise. We will worry about our export market share to the US. Those are given. But at the same time, we're not going to give up on the secular trends that are entrenched in the region. And I think the symbiosis between East Asia and South Asia, the regional supply chain related issues between Southeast Asia and North Asia, and all of Asia, including Central Asia and the Middle East, the powerful drivers of growth going forward. I worry about the near term. I'm not worried about the medium term.
Thanks very much. That's a great sort of scene setter. Salman Ahmed, how are these macro factors driving asset allocation decisions? Are they being reshaped? Are you looking at different models?
No, thank you very much once again. Really appreciate it. So I think to your question, Michael, on asset allocation, I think it is having an impact. I think there is this sense that this is not just noise. I think, I mean, I'll give you a couple of examples. Just look at European defense stocks, for example, over the last year or so, they have massively gained in value. A lot of our equity baskets we follow, which are, for example, whether it's tariff exposed stocks, they have underperformed quite significantly. So there is this underlying forces which are starting to get embedded, because there is obviously a lot of uncertainty about the final policy shape and form. And I agree with the Taimur there in terms of the day-to-day. But how is it impacting asset allocation? So firstly, I think there is more realization that inflation is probably here to stay. Some of these policies which are coming into shape, which may be volatile from a day-to-day perspective, but are inflationary. For example, the immigration crackdown, implementation of tariffs when they come through, and then the critical question of how the Fed will respond to it down the line. And that's impacting, for example, how people are looking at the yield curve and the shape of the yield curve going forward. For example, what's the role of bonds, US bonds, treasuries in wider portfolios. So there's also a lot of focus on hedges in this environment. So dollar, for example, has been a critical hedge for us, because if these policies get out of hand, then dollar really appreciates quite significantly. And then so is gold. So gold has been, been a beneficiary of some of these, shifts we are seeing. So all in all, geopolitics and geoeconomics, I would say, is becoming a more powerful driver of asset allocation. Regional diversification is increasing. We are getting a lot of focus on security issues and security profiles of different regions. Who can defend themselves, who can't, I think is an important one. And I think how the Russia-Ukraine situation, I think, pans out, plus what happens to for example, the Palestinian situation, are going to be critical factors for Middle East in the later aspect, but certainly for European assets, which or have a big discount over US, but you may also see spending move towards defense just because of the threat of what's happening. So a lot of factors in the air, but certainly there is trends appearing which are more geopolitical and geoeconomic than it was the case like maybe even a few years ago.
Okay, thanks. Salman Jaffery, how are DIFC's clients positioning themselves or repositioning themselves given the risks and given these emerging trends?
Yeah, thanks, Michael. It's a real pleasure to be here. It's hard to disagree with anything that Salman and Timur have said. And in fact, I think we are in a very interesting position because our existence and our success manifests a lot of these structural changes that have been discussed. I think realignment is probably the name of the game because the thing about structural change is it's hard to put your finger on it when you're in it. It tends to be post hoc where you can look back and see how things are. But to begin with, just to comment on the realignment, using India and China as a great example, right? The Chinese story may be different, but what impacts us is, for example, the internationalization of that economic activity, right? And so for us, whether or not China grows at 6 or 4 or 7%, what's significantly important as a middle economy between East and West is the direction of those financial and trade flows. So that's one example. India is another example where, again, we can debate on the margin what the growth rates are going to be. But for us, the shape of it, which is, dollar FDI into Indian capital markets as one of the stories, is a very interesting one, right? So we definitely concur vigorously with the thesis of realignment. And I think the key takeaway there is that economies or financial centers or geographies or markets that are positioned to take advantage of these structural changes are well positioned. And I think UAE, Dubai, and DIFC certainly are well positioned. I think the second thing I'd say is, much has been said about globalization's demise. It's not dead. Certainly not dead. And certainly, again, you can debate on the margins, the reduced impact, but the structural changes that globalization imbued global economies are there to stay, I think, right? And so the question on trade corridors is an important one. We know a thing or two about this because, again, the economies in which we operate and that we serve are starting to negotiate bilateral trade agreements. These are very important for countries like the UAE, and it's in the public domain, whether it's with India or other economies. This continues. The one thing I will say is that there is a decoupling between real economic flows and financial flows that we're seeing in a way that we haven't seen before. And the third thing I'll say is agreeing again with what Salman Taimur said. The conversation, the global conversation the last 20 years was largely about economics, and it turns out that political economy is important. Salman used the word geopolitics as a Taimur. I think political economy has reared its head, and it's something which has to be negotiated and understood. So I'll summarize it to say that for us, all of these 3 or 4 things really mean that we pay a lot of attention to the movement of 2 things, essentially 2 assets. One is capital, and the other one is talent. And we'll come back to talent in a bit because to Taimur's point about structural changes, that is something that has absolutely changed. The world, when it comes to talent, is fundamentally different than it was 5 years ago. I'm happy to talk about that next.
Yeah, talent came out very clearly in the roundtable discussion we had in Dubai, and it came up unprompted, but almost universally. The shift in talent, the need for talent, the lack of talent was a big issue. So I would like to explore that a bit later. But Reece, I'd like to move to you too now. And one area where there's clear upward trajectory, it would seem, would be in the crypto digital asset space, especially given Donald Trump is clearly crypto friendly. Over the next 12, 24 months, what should we be looking for?
Look, I think, yeah, absolutely. Ripple are headquartered in the US, so we've been watching it very closely. We've also had our fair share of headwinds from the SEC and the regulators in the US. So, for us, if you look at during the campaign, as you quite rightly said, Michael, President-elect Trump was very open in, stating that he wanted the US to be, and him to be the champion of crypto, even going so far as speaking at the Bitcoin conference in Nashville, Tennessee. And I think since he, has been elected, I think, about $1 trillion worth of flow has gone into the crypto market, which shows quite clearly, the US being kind of one of the largest, most developed economies in the financial services world. Globally, it has a huge influence. I think since then, though, he has followed through with some of his promises, let's say. I think the appointment of David Sacks, serial entrepreneur David Sacks, as the White House AI and crypto czar, really shows a commitment to, I guess, getting, something that has never really existed in the US, where having a framework which is bringing legal and regulation together, and actually having something that will allow businesses to be able to flourish and build in regions without any ambiguity when it comes to regulation. I think we saw very quickly Gary Gensler, who was the previous chair of the SEC, hand in his resignation. And even since then, the SEC have, withdrawn, for example, the accounting rule, which allow SAB 121, which basically allows financial institutions to hold crypto assets without it going on their balance sheet. So really for us, what we see is that banks will now be able to step into this space. I think we still need to see what comes, what the developments are in terms of actual regulation, because people are watching that closely. But I think we're very bullish that the first steps that have been taken will kind of outline kind of the trajectory in the industry for the US and more broadly globally there.
Yeah, no, there's a huge amount happening clearly in that whole area. Taimur, I'll come back to you on the geographical realignments and the new trade corridors that we've been looking at Asia House, and they're very clear from what Salman Jafri said. Where do you see the flows going in those new corridors? We talk often about what we call the Middle East pivot to Asia. A lot going on between China and Saudi, for instance. The UAE very active in bilateral trade deals. The trade ministers out there doing these bilateral agreements very regularly. What's the key or most significant trade corridors that people on this call should be looking out for?
So I think that in terms of foreign direct investment, the action or the quantum of flows is still very much Southeast Asia centric, because that is the supply chain of the world. And whatever China plus one dynamic we see with respect to moving some of those supply chains out of China, first and foremost, it goes to Southeast Asia. We do have 1,100 Chinese companies operating out of Mexico, and that has been like a decade-long trend. It didn't begin with Trump, it predates Trump. And I think Chinese companies would have moved out of China as China became more expensive and the labor force started to age, independent of Donald Trump 1.0 or 2.0. It has been hastened by the trade war and protectionism and various market access issues. What I see very interestingly, to come back to the Middle East, is that the fact that the region is sort of an outlier, while the rest of the world turns inward, Middle East is progressively turning outward. As the rest of the world is sort of re-examining nativist policies, this region seems to be embracing open trade, and which is music to the ears of the Chinese, because they seem to become now the lone voice of free flow of goods and services. The irony is absolutely delicious. I mean, this was the culprit, and now they are the proponent. So whether it is Saudi and Asia, or whether it's the UAE on Asia, and of course Qatar with its very strong energy linkages to Europe and elsewhere, the regions will benefit without any question. The fact that its labor markets are open to inflows, as opposed to most other places in the world, including Singapore, which is very challenging these days to get approval for foreign labor at the white collar level, whereas here it is super easy. One interesting development where I'd see a parallel between one jurisdiction in East Asia and what I see the open regime in the Middle East is Hong Kong. Again, to my point that in challenge lies the route for regeneration. Hong Kong has had a terrible few years, and now they are very, very open to issue professional visas to the whole wide world. They wanted to issue 100,000 professional visas last year, ended up getting 120,000 approvals. If you want to open a business in Asia now, Hong Kong offers more competitive real estate rent and most liberal immigration regime than any other place in Asia, East Asia. So things are evolving, and I like the fact that countries that have been beleaguered by the difficulties of turning inward are now correcting their course and are opening up. And I think that the Middle Eastern countries, particularly UAE, is really the sort of the par for excellence right now.
Salman Ahmed, one of the other findings of the report is the realignment of private wealth, growth of private wealth and its impact, how it's changing. What changes are you seeing in terms of private wealth, the deployment of private wealth, and the decision-making around that?
Definitely. So I think on private wealth channels, we're seeing a lot of focus on private assets coming through. I think the formation of family offices, multi-family offices, is a structural trend, which brings more institutionalization to investment decision making. More trend towards stronger governance standards, for example, which means that demands of our clients on us have increased. They want more. It's not just about reporting, but they want to understand their portfolios. They want to understand the interaction between private assets and public assets. And that's a big area of work. Initially, a few years ago, we were just doing for the largest institutional investors, but more and more we are starting to do it for the private wealth channel, which is as I mentioned, becoming more sophisticated. And then another trend is obviously ETFs, which is not only a private wealth trend, I guess, but certainly quite significant in terms of the building blocks usage and the scrutiny, if you will, put on active management. And that's where, this year, I believe, is going to be a big test as geopolitics, geoeconomics becomes more relevant. Dispersion in returns start to increase. Dispersion between geographies start to spread out. It will be a big test. It will be important test for passive, for example, in that way. And obviously private channels are more agile, I would say, to those shifts than the traditional institutional channel, given the nature of the decision making which comes through. So certainly, private public, and then of course, as I mentioned, passive versus active debate, I think is still going to be an important one here.
That's interesting. The passive versus active, because the growth of ETF is huge. So I just want to pin down, you're saying that ETF will be tested this year?
I wouldn't say ETF being a vehicle. I think obviously people use it as a synonym for passive investing, but ETFs can be active ETFs. So we are, for example, focused on active ETFs beyond smart beta ranges, if you will. So bringing in some research input into portfolio construction. But I think passive generally, I think is going to be important. So last 2-3 years has been about MEC 7s, right? I mean, you could talk about a lot of other things, but if you didn't have MEC 7s, you would have underperformed anything in terms of your benchmarks, right? So that kind of dispersion is now increasing, and I think geopolitics and geomacro is going to be an important one in terms of the cycles it creates. And of course, we are seeing the rise of AI in China, which I think is a major development. And of course, how that mixes overall with the other trends we're talking about.
Okay. So, Jeffrey, similar question to you on the private wealth versus sovereign wealth and the shifts that you're seeing and your clients are seeing there. And also the generational piece, which was highlighted in the report, that a lot of this wealth is going to be handed down to the next generation who may take a very different view of how to deploy capital.
Yeah, it's super interesting. I mean, I guess the headline is that one way to view what the DIFC is currently doing is we're trying to essentially intermediate the conversion of family wealth or savings into investable capital, which then gets deployed into global financial and real assets, right? That's kind of the headline story. And as long as we continue to do that, it's super interesting for a number of reasons, right? Number one is in the region, families represent, or private enterprise represents something like 70 to 80% of regional economic output. And so the wealth that is created, has utility. And in the past, most of it, went overseas and globally, and now there's a lot more, there are better vehicles and opportunities for that wealth to stay a bit more closer to home, both in terms of how it's utilized and how it's deployed, right? Now, the second thing is that is separate from the notion of kind of private assets and where the money is going. Here, as everyone knows, I mean, there are at least two economists, there are at least two PhDs on the call. when oil is over 70 or 75 bucks a barrel, we are in economic surplus in general, notwithstanding individual budget levels. And so that story, that pool of capital is defined, it's sophisticated, and it's been that story is known. But this really interesting story, the same amount of private capital is embedded in generation 3 within families. And that is really interesting because it's at play. Something like $1 trillion worth of that family wealth is now poised. It's in the process of being invested, but it's poised to enter, public equities, private equity, real estate, hedge funds, VC, in a manner, Salman Ahmed, that wasn't the case 20 years ago, where the average investment would be, buying real estate in the UK and expecting cash dividend the end of every year. So for us, it's a very, very interesting time. It has changed the landscape. And I guess that my last point is, why is it significant? Because it introduces, it's part of this new generation, this new mindset whereby you have the emerging market search for alpha growth, outsized returns, entrepreneurship, sitting on top of kind of an economic and financial model that looks very much like what you have in the North, in the developed markets. And when you put those two things together, great things happen.
Okay, one thing that we need to get onto fairly early now is AI and the impact of AI on the industry, but also as an investment destination. And Reese, naturally, this is where I should come to you. Huge amounts of capital flowing into AI investments, startups and the like, but also AI, the use of AI changing the nature of investments. Give us a thumbnail, sort of minute or two, of how you see the AI story in the next 12 months.
Look, I think it's clear, and there's actually quite a lot of convergence between AI and crypto, I would say. But typically, I think we're experiencing it every day. There's somebody who is utilizing the technology a lot more, with the whole industry being able to adopt it quite easily into their business practices is only a good thing. I think for us, from our perspective, we have it into our measures. We are, a global payment service provider. So therefore, for us, we need to actually have a look at how our customers are utilizing our product. This is a manual. We're utilizing AI technology in order to look at the trends, look at where we need to, fund our treasury and so on. Following through, I think that will be a continuation in how we can adopt. And that, you're seeing a lot of talk around AI agents, right? So people actually having the ability for an AI agent to carry out business functions instead of the individuals. And I think, again, with that growth and that adoption, we're going to see a huge amount of success across the businesses and streamlining efficiencies, which is actually how we're looking at how to approaching it first and foremost in our own business practices, and then looking at how wider that can be adopted across our business.
Great, thank you very much. Now, look, we've got well over 200 people on the call now, and they want to ask questions. If you do wish to ask a question, please put your virtual hand in the air. What we're going to try to do is bring you into the program so that you can ask it yourself rather than me reading it off the chat. Firstly, I'd like to come to Lisa Francis. Lisa.
Hi, thank you, Michael. Can you hear me okay?
We can hear you. Can't see you
lovely.
yet, but I'm hoping we'll be able to.
Right, okay. So I would like to ask the panel a question. How do you anticipate the global shift to digital economies and how will they impact the investment flows?
Salman Ahmed, maybe start with you on that one.
So I think digitalization is a journey, right? It's not a destination. So the question would be on these technologies getting incorporated. I think Michael talked about AI and the integration of that. I think that's going to be an important part of the next stage of digitalization of the whole economy. But unlike internet, which was a different technology, I would argue, and happened in a more world which was globalizing rather than right now, which is becoming more fragmented, for a lack of a better word. I think the one additional angle which will be important is the nationalization or national security implications of these technologies and how investor flows respond to that. To give you a specific example, so China is showing, obviously, it's making big progress in AI and creating a cost curve reduction, which is great for every user, should help, speed up the digitalization of the various economies. But the question would be, if people become, or countries become, protectionist about these technologies, and it's increasingly starting to happen. So things can move quickly, but and we have seen that in Europe as well. And you'll see, in fact, we are starting to see what appear as unconnected risk start to get connected. I sit in Europe, so probably is being at the epicenter of the geopolitics shifts happening right now. But just to give you an example, with the Russia-Ukraine situation and the perception of what is happening with Europe, what you're seeing is that they are becoming nationalistic on AI as well at the same time. So these, I think, factors can start to connect, and it will be important that we as investors look at whether these digitalization can make money or not, and who will make money, and who will be accessed at some point to be able to make money on that. So it's I think it's a more you need to take a more holistic view on this, rather than, oh, this is a good technology and it will spread. No, this, we have to ask who owns this technology, who are they, allowing it to be used, and then, of course, the biggest question: can investors make money out of it? Because last point I would mention is that, bicycles are a great technology, but nobody made money from bicycles. So we have to differentiate between the technology and the returns which come out of it.
Really good point. Reese, I'll take this. I'll ask you to give your views on this.
Yeah, I think I'll give a view from a, I guess, blockchain crypto perspective. I've been at Ripple for 7 years now, and I can tell you my conversations for the early part of those first couple of years were very different to what they are now. Banks typically were very closed off, not very open to incorporating any form of digital asset strategy. And really, we've kind of gone full circle there. We've been asked to go back in terms of how, certainly across this region, very advanced in terms of how can a bank incorporate new technology when it comes to digital assets. If we talk about tokenizations, if we talk about stable coins, in a regulatory safe framework. And I think that's the biggest blocker to advancements in each different pockets of regions is the different levels of regulation. The UAE have done a phenomenal job in setting out clear frameworks, which is why banks and large institutions have the ability to incorporate digital asset offerings. US at the moment, opposite end of the spectrum. That may change, but unfortunately, until we have a more broader regulation across the whole globe, and then trying to piece that together, I think there will be still some issues there.
Now, Salman, Jeffrey, it does bring us onto the regulation piece, does it not? In that regulatory fragmentation is a big issue and a growing issue, and an impediment to growth. Again, what DIFC clients telling you?
Yeah, so let me make three very quick comments in digital, and I'll include kind of AI generally in it, right? One is in the context of what's been said about flows in East and West. Let's not forget the importance of technology as an equalizer, as a source of competitive advantage between large and small economies, right? So that can't be understated. The second thing I'll say is when it comes to, I'll say something slightly provocative, which is you can view digital as kind of a necessary background. It's a hygiene factor, right? You can't compete without it, but it tends to mean revert performance because everyone gets digital, costs go down, and it's standardizing. AI, on the other hand, at least in the short to medium term, has the potential for generating excess return in a highly competitive fashion, depending on how the models are used and who gets them first. And I think it's really fascinating, particularly with recent developments with what's happening in China. Our role, the third point I'll say, is enablement, which is about platform, talent, and regs. And I will say regs are very important. We've had regs for crypto and tokens for 2 and 3 years respectively. And it has to be said that up until recently, one of the big reasons why we had massive inflows into Dubai and to UAE is because there was this big void in North America. And as Reese mentioned, I just came back, from the US in January, and I'll tell you, in financial markets and in digital asset markets, the animal spirits are raging once again. So it'll be very interesting to see, Reese, to your point, whether how much of this translates into sustained kind of enablement, as it were, of crypto from a regulatory perspective. US, of course, has other issues, which is it's so fragmented, right? State regulations and et cetera. But so, Michael, just to answer your question, regs are super important. We've had them, and very important that this space has rules and regulations.
Okay, thanks. A quick one on this, Timur.
A couple of things. I think there are still this old question which has not been fully answered, which is, what kind of problems are crypto solving that a fiat money system and the fiat money linked digital banking system is not solving. We can talk about Bitcoin in the context of a store of value. We can talk about it in terms of a speculative asset, and it's done very well for those who have speculated, myself included. But at the same time, I think there is a question still about, what problems are they solving, which the real-time gross settlement system of the central banks of the world do not. Second issue, if I may just go back to something that Salman was pointing out, that what's happening with oil prices and the region's capacity to sort of fund its ambitious developments. Let's also note that in inflation-adjusted terms, oil prices are at a 40-year low. The ambition to build in the region is sky high at a time when oil is at a 40-year low. And if Trump's drill, baby drill even has a fraction of an impact on the global supply of energy, I see another downtrend in energy prices. This could be a point which we as a warrior can say, well, this is a thing to worry about, but also we can see this as an opportunity, which is that the region in the past has been very capital rich, but especially with the Saudis, I see that they're out there raising capital. It's no longer that, I have an unlimited checkbook and I can fund whatever I want. It is more like I have the regulatory environment, I have the tax system, which you should take advantage of. And by you, I mean China, Southeast Asia, US, whoever, bring your capital in. I think this is going to be a fascinating area to watch, how Middle East convinces the rest of the world to keep coming here and investing at a time when its cash cow, oil, may not be as lucrative a cash cow as it has been for a long time.
Thank you very much. Lisa Francis from Lloyds, thanks very much. Next question now, Rita Chidiak from ACCA. Rita.
Thanks a lot, Michael, for the opportunity. Hi, everyone. Thanks for the information. Very valuable. I'm Rita Chidiak, the new public affairs lead for ACCA Middle East. We're a global professional accountancy body, and we have around 11,000 students and members in the UAE. My question goes specifically to Salman, and it's about a very, very hot topic, which was not really raised earlier, sustainability. We have now the new international sustainability standards being launched. I'm keen to understand what the Dubai government is keen on doing about upskilling the workforce, investing in new skills, and how can we, as ACCA, work better with the DIFC to support that upskilling? Thanks.
Thank you. So I guess that was for this Salman.
Yeah, I think so.
Let me comment at a high level about what is known publicly about, I guess, the UAE and DIFC's approach to sustainability first, which is it is in the public domain that the UAE as a country, and certainly therefore the DIFC as a financial free zone, have net zero aspirations that are at the strategic level. In the case of the UAE for the economy, in the case of DIFC for our ecosystem. And these are pretty consistent with, again, various aspirational standards for sustainability. In the case of the DIFC, two quick observations. Those goals manifest themselves in two different ways. One is in what we do as a going concern, as a company that owns assets and buildings and has a responsibility to ensure that they are LEED certified, that they're sustainable, that there's solar energy, et cetera, et cetera. And number two is what we do for our community to enable our 6,500 rich ecosystem to fulfill their own individual corporate level objectives within ESG and particularly for sustainability. I guess it's a longer conversation. The one thing I will say is a fair amount of work is being done and needs to get done when it comes to training, accreditation, awareness. And for example, our regulator, the DFSA, is in the process, for example, of drafting guidelines for financing, how you would do financing from the DIFC across asset classes that are green and sustainable. So to support all of these things, I guess the answer to the question is we will continue to invest in, training at the DIFC Academy, and we're happy to partner with anyone who has a view or has content or has an interest in participating.
Thanks very much. Lots of questions. We are coming to you. We'll get as many of you in as possible. Hamza Al-Gaud from TS Lombard. Hamza.
Thanks, Michael, and thanks for the time, you guys. I've got a two-pronged question. So, we've talked about very briefly and touched on the macro turbulence that has sort of hit the Middle East. And, everybody's talking about Trump, talking about tariffs. But what I want to focus on and get your opinion on is sort of how the Middle East and specifically the DIFC and the GCC are gearing themselves to sort of play the political middle in markets as the leading sort of, broker of power between the East and the West. In other terms, can the UAE and the GCC sort of serve as the new Switzerland or the new Singapore globally?
Salman Jeffrey, that has to start with you.
Yeah, I'll take a quick shot. Look, de facto, given our location, we have always lived amid geopolitical risk. So let me have the facts speak for themselves. Over the 12, 15 years across multiple ripples in geopolitics, both regionally and globally, Dubai and DIFC, by and large, has been a net beneficiary by virtue of the stability of the regime, as well as in the case of the DIFC, our kind of Western English common law based independent financial legal system, right? Financial services is all about contractual certainty and recourse. We provide that. And so we are viewed, I think it is accurate to say that we are viewed as a safe haven, as a Switzerland of sorts. We don't actively talk about that, but that is the net result of I think, our positioning. And the second thing I'll say, Michael, very quickly, linking it to talent, economic growth relies on the free movement of people and talent. And one of the things that we are free of, by we, I mean DIFC, Dubai, UAE, is we are free to work with many other population pools that are not accessible to other economies. So getting top-notch people from East and Central Europe for us is not a problem, and which really helps in our positioning.
Salman Ahmed, I'd be interested in your view on this too. The Gulf countries being the new middle powers, the new Switzerlands. How is it going to change, or are you seeing that trend, and is that changing asset allocation decisions?
Look, I think it's early days, and to be fair with you, I think the kind of geopolitical shift we are seeing is probably unseen since the pre-World War era, right? The fracturing of the Western Bloc. Nobody knows how people are gonna be exposed to it. I mean, there's one thing, we're having two Afghan wars, which are insignificant compared to the shifts we are seeing right now. But I think there are two, three things I would raise. Firstly, I think the US-Europe relationship is going to be an important one to get into a new steady state in the next couple of years or so. And I think at least in the short term, obviously you have the Russia-Ukraine situation right now, but there's a Greenland situation as well in the background, which is a very contentious point. So if you have fracturing of these two blocks, and then there is a focus on security, I mean, we have to raise the question, how will city-states fare in that environment? When everybody becomes, defense-focused, security-focused, and become nationalistic in their capital flows as well. So it's early days, and I think a lot of that will depend on whether this is all deals and some negotiation will come through, or there's a structural rip between the major blocks. So what are we watching? We are watching the governments in Europe very carefully that whether they will, as the tariff wars and everything goes in, whether they will retaliate or not, whether they will retaliate to capital or not, because one of the major, at least stating points of Trump administration are that they want to bring capital back to the US. But as a major capital providers, you can put blocks on it. You can put exit taxes. So, for example, European companies coming to Middle East, they may say, you know what, put taxes on this. And or US, if you are, drawing capital quite significantly. So we have to watch that retaliation very, very carefully. And then secondly, obviously, the US-China decoupling. China is going towards self-reliance as well. They want to produce themselves. They want to start consuming themselves. Effectively, they don't want to be, more and more we engage with them. They don't want to be dependent on external capital anymore. So this kind of, I think, trends are probably more slower moving, but may completely change the picture of, the world we see right now. But again, these are early days, and I think how the Russia-Ukraine settles, I think, going to be important for Europe's mindset. I think towards how to deal with the US, and then I already raised the Middle East question on Palestine, because that's going to be important, right? I mean, from a European investor perspective, I've got so many questions on people saying, how will that play out? How will these countries defend themselves? For example, if you have the kind of plan implementation you're talking about. So there are big questions now being raised, and I think I am careful, or would be cautious about interpreting the last 20 years here, because they don't look like it right now.
Okay, there's a lot of questions. So let's get to the next question now. Hamza, thanks very much. Market Treacher, RTGS Global. Marcus, hi.
Thanks. Kind of going on for the earlier question of how trade and movement of funds becomes more difficult in a much more kind of balkanized world, and looking at how the methods of cross-border payment were developed in a more unipolar world in the 70s and the 80s. Question really for Reese and maybe the other panel. Do you see the current realities of a more deal-related, less reliable global trade scene accelerating the move to newer, faster, more immediate cross-border solutions? And could the Middle East be a driver in creating much more interconnected ways of moving value, trading, and settling for commerce that are much more, what's the word, are much less disturbable by the cut and thrust of geopolitics?
Reese, that one to you.
Sure. Thank you. Thank you, Marcus. Thanks for the question. So I think, Ripple have been very focused on cross-border payments for some time now. And we believe utilizing digital assets, XRP, as a bridging asset between two fiat corridors is a much more efficient and quicker way to move funds globally. I think as we look at our product, $70 billion worth of value being moved there. So there's clear product market fit. And what I would say is we've seen an evolution in stable coins, predominantly USD-backed stable coins, which I think are generating new use cases. I know outside of this region, or sorry, within this region, enterprises are using it for settlement to the Far East, for example. Because if you think about I'm an importer today, I have to send a US dollar payment over to the Far East. That has to go via the SWIFT network, which goes via the US and then over. It's costly, it's slow, it takes time. So being able to settle a USD-backed stablecoin will take a couple of seconds and cost a fraction of a cent, is a much more efficient way, we believe, to move funds globally. And really, where you have the US dollar pegged to a number of currencies in the GCC, the circulation of dollars is very high. Therefore, being able to add that element of efficiency, we see as there's going to be a ton of growth there, which is starting, but will take some time, I think, to develop.
Salman Ahmed, I see you nodding at this. Do you concur?
No, definitely. I think cost optimization is going to be important driver as well, and also the need to diversify, to risks, right? I mean, and this is obviously I think this became a very big topic 3 years ago when the sanctions were used against Russia. I think this is probably going to become another one in the next year. So I just note, I'm sorry, I'm going to bring a Eurocentric view here, European-centric view here, but I will just note that Europe just increased sanctions on Russia as a response of what's happening. So what I'm saying is that you're going to see demand for what Reese was talking about, on a more structural basis.
Amir, your view? Tamir, your view on this one?
Right. So as I said earlier, that there are certain challenges for the ubiquity of crypto assets in the lifeblood of the global financial system. Again, goes back to the question, as Reese was alluding to, that are there really cheaper, faster solutions being offered for an issue that is problematic right now? Now, we do have trillions of dollars of cross-border payments happening on a regular basis through the fiat currency system, through the normal banking channels, and through the SWIFT networks. What we have now is a geopolitical dimension to it, which is we don't necessarily want to be always SWIFT-based. And that sort of monopoly breaking down perhaps opens up an opportunity for the stablecoin-based digital system. And of course, as Web3 gets more developed, perhaps that's where the other conduit becomes relevant. But the key issue is, to the very beginning of the conversation, the fragmentation of the world. And by that, I really mean the US turning inward. I don't necessarily see Europe turning inward, and definitely Asia and Middle East and North Africa are not turning inward. So we basically have to come up with a new nomenclature, which is world ex-US. And we can sort of, write things about that world and payments and settlement for that. And the US can do its own thing, at least as long as Trump and Vance are around.
Well, okay. Thank you very much, Marcus. Thanks for the question. Look, I'm afraid we're just about out of time, but I'd like to finish, if you don't mind, with you, Salman Jafri. We talked a lot about realignment. That seems to be the core theme. We're going through a period of substantial realignment, whether it's geographical, structural, investment flows. What do we look forward to in the next series of reports? What are the key pieces, key themes that we will be looking at?
Yeah, so I want to first, thank my fellow panelists. I mean, it's amazing to learn from them, and I think the themes that we've heard today are going to be echoed in the next few versions of this conversation. Look, I think realignment brings with it a pretty sobering and serious conversation on things that are changing, things both in terms of rules, regulations, business culture, trade flows, asset classes. So I think a few things top of my head, I'd say we are going to be very watchful, do a lot of listening to what our clients are viewing and experiencing, because ultimately to be able to serve these emerging, changing needs. And by the way, Salman and Timur are right to say, and Reese, that it's hard to make categorical statements when you're in geopolitical economic change. But the best you can do if you're in that mode is to make sure that these conversations happen. Number two is that there's a free flow of information and views. And number three, that we're consistently evolving and ready to meet the needs of our clients. And so over the next few months, technology, capital, talent, regulations are all things that we'll be covering.
Tremendous. Look, it just remains for me to thank all of our panelists. Salman Jafri, thank you very much indeed. Salman Ahmed, Reese Merrick, and Tamir Bag. Thank you to all of you as well for taking part. It's good to see so many interested. This is a fascinating issue. We're going to be covering it in much more detail in the months ahead. Thank you for being with us. Do take care, and we'll be in touch very soon. I recommend the report. Do take a read. Any feedback, send it our way. Thanks so much, everyone. Take care. Goodbye for now.